So this is a great point, especially when you combine it with the previous point. And we think about what is the mindset of these managers, these CEOs, what is their incentives, and do they treat the company like their own? In my checklist, I've labeled this one, or similar point, is do they have skin in the game? We like to give extra points if it's the founder of the company and he's still the CEO, because they're treated more like their baby. They care about the future of the company like we would, the long term. So often founders make excellent CEOs, always gets extra points for that. And if they're not the founder, you can see if they've got skin in the game by looking at how much shares they have. And are they buying more shares or are they selling shares? Now, selling shares is not always a bad thing, unless it's very sudden and a huge amount. And all the other C-level executives are selling at the same time. That can be a bad sign. But usually, if they've got a good percentage of the company and they haven't sold for a long time, or if they're buying more shares, it gives a lot of extra confidence that they are in it for the long term and they believe in the company and what they're doing and that they're planning for great things. So yeah, seeing if they have skin in the game is it's definitely a way of seeing if they treat it like an owner would. Another thing I like to look at is when they do buybacks, that usually results in you owning slightly more of the company. So they're using your money basically to get rid of other owners and destroying those shares, thereby increasing the percentage of the business that you own. If they do this at a time where the stock price is overvalued, then you're effectively, they're using your money and spending it at a time when you're spending too much money for the result. But if they do it when the stock is undervalued, they're doing a great thing for you, increasing your value that you own as a business at a very low cost. So by looking at these kinds of actions, their own ownership and how they spend your money on buybacks, you can kind of get a good impression of what kind of a manager is this. Is he treating it like in your favor as the owner, or is he doing it in his own favor just to benefit himself based on whatever metrics might have been put in place by the board? So that's my thoughts on that.
Yeah, and these are great thoughts. And of course, we also need to look at the buybacks and all this stuff with the management. Yeah, the next point I think is also really interesting and very important for myself. When we look at the annual report or any kind of report, we need to understand whether it is written like the marketing document or it is written like the document to tell the truth to the shareholders. Because usually, in most cases, there are companies where the CEO just writes the words like, we are one of the best company and we are ahead of the industry and we produce great results this quarter or this year and we achieved this and this. And then you go to the income statement and you see that actually the performance is lower than the previous year. The company is losing money. It issued more shares and the return on equity and return on invested capital is lower than the average on the industry and the competitors. But the management doesn't say that, and this is one of the quality. And I think that the management could need to be honest with the shareholders because it is like the family, and these people trusted the company and the management and put their own money into it. And usually you can just do it automatically remotely without talking to management. So it is a huge and enormous credit of the trust, which you need to consider. So in this case, the management should be 100% honest with any upcoming and current events, even if they are negative. And this is one of the red flags for me if I see that the company just try to not lie, but not to say things which are obvious.
This is a great one. Looking at the management letter that they write once a year, in that annual report. You're looking for, you don't want to see a manager who's just writing hype and marketing material and trying to get more investors to invest. You want someone who talks about their mistakes from the past and what they learned from it. You want to see them talk about challenges that are currently the company is currently facing. You want honesty. Some of the best managers in history have been very upfront with investors and say, look, we're not going to get a great quarter in the next 2 quarters. We've got this problem. It will be resolved, but we are not looking at good quarters. And so that's the kind of honesty you're looking for, because you must think of yourself as an owner because you are one. And so you would want the management that you've hired, the CEO, to be honest with you about the state of your company. So this is quite critical. One of the things I recommend on this front is, one, you can pay attention to the stuff we've just discussed, and two, you can write down if you're reading like 10 years worth of annual reports, you'll see where the manager says we have a 3-year plan to do X, Y, Z. We have a 5-year plan to do whatever. When they make promises or they make commitments, check if they mention those things in future reports. If they just never mention it again, that's not so great. But if they say, we're on track on this plan we put in place, or we've succeeded, or we've fallen behind, we want honesty, we want transparency, we want them to report stuff to us, not just give us a beautiful sounding plan and then sweep it under the rug like it never happened. My biggest recommendation really, I think, is there's a wonderful book by a very smart woman named Rittenhouse. And the book is called Reading Between the Lines. And what she teaches you is a way of taking the letter from the CEO and seeing numerically a score for how much rubbish they're talking. She's got kind of a method of seeing, are these people being upfront and honest, or are they just waffling things that don't actually help? So in the book, she basically walks through a method of quantifying something that is usually qualitative. So qualitative would be something that's just your judgment, like, oh, it's a nice day today, or the CEO seems to be honest. And quantitative is turning that into numbers that you can go honest, not honest. So I recommend that book. Over to you, Eugene.
Usually investors, especially in the beginning, they can buy not so great companies because they see this marketing stuff in annual report and they think that the company is great. And one of the reasons I think that can change that, or one of the reasons why it is happening, is that in most cases people do not know what are the greatest annual reports. I would probably recommend you to go to the internet and find really, really great companies. Everyone knows them, like Amazon, Google, Apple, Berkshire Hathaway, and just try to read their reports and understand how they present the information and understand how they say about their success and failures. After that, you will understand and you will have some kind of the pattern when you just read the annual report of the particular company, and you see you would immediately see these things like the sales and all the marketing stuff. This is the way our mind works. So that brings us to the next point of our checklist, is whether this stock is held by the top value investors. And not every investor who manages like hundreds or billions of dollars with several hundred of stocks. By that, I'm talking about people who have like 10 or 20 stock portfolio, and they have most of their net worth in this particular company. Because if, for example, the person manages like 100 million and he puts 30% of his money into one particular stock, probably he did some great analysis, he knows something, he understands that this company can be great and it can achieve higher results. What do you think about that, Nick?
I like this one a lot. It provides an extra margin of safety beyond our own research and beyond our margin of safety price that we purchase at. It means that great investors who are working with millions of dollars have agreed with you that this is a company that is worth investing in. And a lot of the time, you can buy the companies even cheaper than when they bought in, which lends even further margin of safety because, if they thought it was great at that price, you can get it even cheaper. So that's a wonderful thing. I like your definition for the kinds of investors we want to follow. Any portfolio that is under that where 80% of the money is in less than 30 stocks is probably a good contender for a value investor. So you can use certain websites to find these guys and to see if they are investing in the company you're looking at. The main thing to bear in mind is you'll only find most of the time the larger cap stocks. When we look at smaller cap stocks, the gurus and large investors don't go after them because they're too small. But it is nice to have that extra surety that a great investor has chosen the same company as you.
Yeah, and this is the extra, I would say, layer of filter. And then bring us to the different set of indicators. They are more financial ones. So it's like the return on equity, return on investment, and return on invested capital. And I try to look for businesses with high return on equity, like above 10-15%, high return on investment in invested capital, like also 15%, and high return on assets, also 15%. This shows how well the management manages the company and how well they allocate the capital which already is in the company, or how well they can allocate retained earnings from the shareholders. What do you think about that, Nick?
I think that every investor will find their own set of numbers that make sense to them and appeals to them. I do like these numbers that you've mentioned. Personally, one of my favorite things to look at is the growth of certain indicators. So I'll look at was the growth in their sales, above 10% the last 3-4 years. Because if they're growing their sales 10% every year, then of course the stock price will follow because these things are connected. And return on invested capital, I do like to see more than 10% because effectively I want to grow my capital, and they are effectively investing my capital. That's what that indicator there is. It probably is one of the most important numbers of all the numbers is the return on invested capital. Over to you.
And the next set of indicators is also connected with the growth. And we need to understand how well the company manages the money. So do they constantly do the buybacks, their dividends, or their repurchasing or paying off the debt? Because if the company has their obligations on some point, we need to understand how well the management clearly sees the situation and can hedge from different risks.
Yeah, I like these. I like these a lot. I think just bear in mind that when you're looking at a checklist, if, for example, one of the points in the checklist is, take a look at their dividends and they don't have dividends, it doesn't mean cross the company out. The checklist is really to get a good feel for, is this company, what is this company doing? And do you understand it? And, where are the pros and cons and what gives extra points and what takes points away? With dividends specifically, I personally don't even like dividends. I'd rather that they would invest it in the other methods, buybacks and all that kind of thing. Although if it does have dividends, I like to add the dividend to my projected growth rate of the company because effectively my money will be growing, not just at the growth rate, but also the dividend is growing my money too. So I add those two numbers together when doing calculations. Some people don't; they just take the dividend as a little bit of free cash, and then they think about the other stuff. And then other people ignore everything else and they just look at the dividends and go, this is my passive income. So there's lots of ways of looking at it.
And actually, another important indicators can be, besides growth and all these accounting numbers, which of course are really, really important to understand and try to think why Mr. Market gave you this opportunity. And do the company has the certain margin of safety for the purchase? Because for example, we looking for the company and we found some with their great numbers and great margins, but the market is totally undervalued it. we can say that, okay, this is a bargain. But if you go further and you conduct your research, you can find out, for example, that the company's CEO is being judged by the court. The market is just on the downturn, and probably the market just thinks that the revenue will drop down. So you need to be very careful for that, and you need to understand whether you buy the company at the margin of safety.
When a company's price goes down, the main reasons would be that there's a lack of confidence in the company, or some sort of uncertainty about the company would be one of the two options. And then the other option is that it's the market as a whole reacting to something that isn't even related to the company specifically. It's just a generalized uncertainty in the market. And so those are two causes. And then the two questions you must ask yourself, or the one question really, is it the price going down? Is it indicative that the value of the company has gone down? Or is it unrelated to the value of the company and the value is still there, and now is a good time to invest? So if the value has gone down, you might not want to invest. The price going down doesn't not necessarily mean you want to buy in. But if the value is still there, you might be buying it at a bargain. And so those are my thoughts on that.
Yeah, I absolutely agree. And I usually try to understand the value of the company before looking at the market cap and the stock price. For me, it's better to just compare these numbers. And then when I do the calculation and I see that my calculations are higher than the market cap by probably 40 or 50%, and the market undervalues this particular company, I will continue to do my research. Another important factor, I think, that we also need to consider asking this question about the analysis. What did I miss when I did the research? And is there some room for the mistake, which can lead to loss of the money?
This is a very similar question to what they ask at over by David Gardner and the Motley Fool. Is they'll go through their checklist of 25 to 27 questions, and then the last question is, what question have I not asked that is super important that can increase the risk of this investment? Because every company is different, so you can't ask the same 25 questions of every company and miss nothing. There's always going to be something that's unique to that situation or that company. So they leave a question for a custom question that you need to really think about. What is unique in this company that I haven't asked already, risk-wise? What is that question? And that is a question right there. I think that's very similar to yours. I like it a lot.
This is a really great question, which makes you to rethink about the analysis and look at this one more time. This is my checklist. Of course, I will add more points little later, because we all continue to educate ourselves and grow as value investors.
I think one of the ones we should do in a very soon future episode is Bill Ackman's eight questions. And so just 8 questions, but I think it covers so much. And if you can't answer those 8 questions correctly for a company, maybe it's not a good investment. That's my thoughts.
We hope you really enjoyed our video and it was useful for you, and see you next time.